Today's lesson we learn depreciation and inflation. And with that, we have three learning objectives. First, we explain the depreciation and method of depreciation. Calculate the depreciation using different methods. In this class, we discuss two methods, and that two methods of depreciation also cover in your FE exam and available in the FE reference that I will show you in the next videos. Explain and calculate the effect of inflation in the project financial evaluation. So first, let's discuss depreciation. So what is depreciation? Basically the process to recover the capital investment. So you buy the equipment, you buy the furniture for the company, then that investment can be recovered over a period of years, and that we call recovery period. And depreciation is a tax allowed deduction. Normally, the typical equation to determine the taxes, your income, subtract all the deductions, and can apply for personal income or corporate income. When you have that deduction, all the deduction, it become a taxable income, and then we time the tax rate. So bottom line, to determine the tax equation, simple: income regardless of personal income or corporate income, subtract all deduction, and depreciation is one of the deductions allowed. There are other deduction that you have, but that is one of deductions. For example, in personal income, the amount that for a family, childcare costs, that can be a deductions in this equation to determine the tax rate for personal income. And then you time the tax rate. So that, again, depreciation is considered one component in the deductions. For the terminology of depreciation that I going to use in the slide here so that we can go over that. What are the terminology used in the depreciation? First, depreciation D is the reduction in value of an asset. So annual depreciation at certain year J, so we call D sub J, and that is, again, we mentioned earlier, that is tax deductible. And it depends on how much you invest for that equipment or that facility, and that we call it first or initial cost. So the install cost of the access, including purchase price, delivery, taxes, installation fees. However, what I consider that initial costs, we will talk about the declare initial cost of an access before we use at a depreciable cost in the next lesson videos. But in this case, for now, that is initial cost that you think that is C. But we need to deduct, for example, if you buy the equipment and have including something that easy to wear out, it cannot be last for long. You buy a pickup truck for the business, the pickup truck can last for 5-10 years, but the tire itself cannot last that long. You have to replace every 1 or 2 years or 3 years. Then the tire costs cannot be considered depreciable costs. It should be considered the current expense in the current year. We will talk about that in next lesson video. Book value, the remaining undepreciated investment on the books after total amount of depreciation charges. So all the depreciation that you calculate so far will be deducted, and that from the initial cost, that we call it the book value, BV. Recovery period, the depreciable life of an asset in years, and it depends on how it allow for IRS. If you do for the tax purposes, you buy a laptop, it cannot last 10 years, so you cannot recover in 10 years, maybe used for 3 years. Long-lasting equipment, just like an excavator, you can depreciate it in 5, 7, or 10 years. Market value, the estimated amount realizable if the assets were sold on an open market. So that you can see, if you buy a car, you want to check what is the value of the car that you want to buy. You go to Kelly Blue Book, and that is Blue Book, something we discussed earlier in the previous slide here, book value. But the market value is the amount that you really spend to buy a car. things like that. We call market value. So it's in open market. So it don't need to be book value. And the depreciation rate or recovery rate, the fraction of the first cost removed by the depreciation each year. And that depends on the method of depreciation, and that we will discuss in the next lesson video. Half-year convention. What a half-year convention stand for? We assume the assets are placed in service or disposed in mid-year. What does that mean? If you buy a pickup truck and you want to use that for depreciation, for deduction in your tax, then even you buy it in January, it consider you put that in service in mid-year, June, July, or you buy it in December, it's still considered in the mid-year, June, July. So that is the first year it will be considered the half, because it put in service in half years, regardless of which month you buy or put that equipment in service. Similarly, when you dispose at the end of life, after 5 years you use, you sold that equipment for the service value in January or December, regardless, we consider in mid-year of that year, so half of the last year. So that what is about for half-year convention. Service value I just mentioned earlier, and we have discussed that in the previous lesson. So that is the estimated trade-in or market value at the end of the asset. You want to sell your car after you use, you can put in Craigslist or things like that, and whatever the amount that you sell for that car is called service value. Personal property, so any income producing tangible possessions of a corporation used to conduct business, like pickup truck, vehicle, office furniture, that we call personal properties. The other properties also deal with the real properties, and basically that is real estate or any improvement, like you put the building, warehouses, offices on that real estate. However, the cost of real estate including what? The land and the facility on top of that. Then to be considered for depreciation, you have to separate the land cost that consider a real property, but it not depreciable. Only the office building, the warehouse, etc. It is depreciable, but not the land itself. So even real property, we have to separate those two values. One, real estate, the land itself cannot be depreciable, but then the facility, physical facility put on that land can be depreciable. So those are the terminologies, and then in the next one video we will discuss the method of depreciation, and then we apply that in the problems.